Welcome to the deep dive. Today we're jumping right into Mackolik Internet Hazmetleri Ticaret Base. We'll be breaking down their consolidated financials for the first 9 months of 2025. Our goal here is really to sift through the numbers and give you, the individual investor, the key takeaways you need on where this company stands.
Exactly. We're looking at, the core stuff.
Yeah.
Operational health, growth patterns, and capital stability. And crucially, comparing this 9M 2025 period directly against the same period in 2024.
Okay, but before we dive deep into the financials, let's just quickly profile the company. Mackolik, they're based in Istanbul, right? Operating in digital media and IT.
That's right. Their main business is ad revenue from these really popular live score platforms, Mackolik itself, Sahadan, and Match Indirect over in Europe. They're big in the sports media space.
And it's not just Turkey. They have a pretty significant international reach.
Oh, definitely. They've got subsidiaries in France, that's Activa Web as SS, and also in the Netherlands with M Sports PV. And something new and interesting, they set up Mackolik Technology A just this past July.
Ah, the technology subsidiary. What's the focus there?
Seems to be squarely on AI and R&D. It signals, a real push towards future tech and innovation in their field.
Makes sense. And internally, are they growing their team?
They are. Average personnel count went up to 143 in these 9 months compared to 112 last year. So a decent jump.
And what about the folks at the top? Executive compensation.
Yeah, the total gross pay for executives hit 37.4 million Turkish lira for the 9 months. That's a slight increase from 35.5 million in the same period last year.
Okay. And ownership. Who's really driving the bus here?
It's quite concentrated. VDS Yeni Media holds 51% of the shares, but, and this is key, they have privileged A shares, giving them over 70% of the voting rights. So they have very firm control.
Got it. Okay, let's switch gears now and really dig into the performance. The financials for 9M 2025 versus 9M 2024. How's the top line looking? Revenue.
Pretty strong, actually. Overall revenue, or hasalat, reached almost 810 million lira. That's a solid 27% increase from about 638 million lira in the prior year period.
27% growth, nice. And does that translate down the line? Profitability?
It does, and maybe even more impressively. Let's talk FAVO, that's their EBITDA equivalent. It grew by 32%, hitting 466.2 million lira.
32% growth in FAVIC, wow. What about the margin?
That's the really striking part. The FAVO margin actually improved. It went from 55.5% in 9M 2024 up to 57.6% in 9M 2025.
Hold on, 57.6% FAVIC margin. That's incredibly high for almost any business, let alone digital media. That signals serious operational efficiency.
It really does. It's a benchmark kind of number. And the net profit follows suit. It jumped significantly to 279.1 million lira.
So when net profit margin improved too?
Yep, up from 30% last year to 34% this year. A full 4-point improvement. We should probably note, though, that international revenue share dipped slightly, from 18% down to 16% of the total. Still significant, but a small shift.
Okay, strong profits, strong margins. Now let's look at the balance sheet and maybe what they did with all that operational success. Any major capital events?
Oh yes, a big one. They did a 300% bonus capital increase. Basically, they quadrupled the number of shares outstanding, boosting the nominal capital from 25 million TL to 100 million TL.
Right, issuing bonus shares from reserves.
Yeah.
So even though net income went up, the earnings per share.
Exactly. The EPS actually went down because the profit is now spread over 4 times as many shares. It dropped from 7.69 TL to 4.63 TL per share. That's important dilution context for investors.
Okay, that makes sense. Now, what about cash? With strong profits, you'd expect cash to pile up, but looking at the report.
Well, that's where the story gets interesting. Cash and cash equivalents actually dropped quite sharply. Went from about 126 million lira down to just 69 million lira.
A big drop. Where did all that cash go?
Primarily back to shareholders. Very aggressively, actually. They paid out 155 million lira in dividends from the previous year's profit. And on top of that, they ran 2 significant share buyback programs, spending 108 million lira to repurchase about 2.75% of their own capital.
Wow, okay. So huge dividend payout plus substantial buybacks. That easily explains the cash drain. How did they manage that outflow? Did they take on debt?
They did. That's the other side of the coin. Short-term borrowings, which were almost non-existent before less than 1 million lira, they spiked to over 90 million lira.
So they essentially funded a large part of those shareholder returns by taking on short-term debt, replacing cash reserves.
Precisely. Now, the overall borrowing to equity ratio is still manageable, around 33%, because their equity base is strong. But it's a definite strategic shift you need to be aware of using leverage for returns.
That's a critical dynamic to watch going forward. Any other significant items impacting the cash flow or bottom line?
Well, there was one notable charge. They had to pay an administrative fine of 9.74 million lira to the Competition Authority. That's a regulatory cost that hit the books during this period.
Right, important disclosure. But despite the, let's say, aggressive capital return strategy and the fine, are they still investing in the future? You mentioned that new tech subsidiary.
Yes, they are balancing it. They launched the beta version of their AI assistant, the Mackolik Yapaizeka Asistanya, or Maja. The management commentary frames this positively, focusing on operational development.
Okay, so let's try to wrap this up. What's the core takeaway here for someone looking at Mackolik?
I think the main story is this. Operationally, the company is performing exceptionally well, profitability is accelerating, and those margins, especially the FAVK margin, are truly impressive. But that strong performance was immediately channeled into very large returns for shareholders through dividends and buybacks. And funding that required a significant shift, drawing down cash and increasing short-term debt. That's the key tension, I think.
So here's maybe a final thought for you to consider. With Mackolik demonstrating such high operational efficiency again, that 57% plus FAVK margin is stellar and making clear moves into R&D with their new AI focus. The real challenge, perhaps, isn't just maintaining that efficiency, but translating it into sustainable market share growth against tough competition in digital media. Can that operational prowess fuel long-term dominance? Something to think about. If you found this deep dive useful, please do hit that like button, subscribe for more analyses, and share it with anyone else who might be interested. Thanks for tuning in.